Welcome back to Financial Market Insights for Traders, the podcast that keeps you ahead of the curve with deep dives into the forces shaping global markets. I'm Sophia, and today we're talking about something that affects every trader, whether you're a retail investor, a day trader, or running high-frequency algorithms, how regulatory changes impact trading strategies. Regulations in financial markets are not just about rules and compliance. They reshape market dynamics, impact liquidity, and force traders to adjust their strategies. Whether it's a new tax policy, restrictions on high-frequency trading, or an overhaul of leverage limits, regulations can make or break trading systems. Understanding these changes isn't just an advantage, it's a necessity for staying ahead. So, in today's episode, we'll break down how different types of regulations affect trading, look at real-world case studies, and talk about how you can adapt your strategies to stay profitable in a changing regulatory landscape. How regulatory changes affect market dynamics. Before we dive into specific trading strategies, let's talk about the bigger picture. When regulators impose new rules, they typically aim to create a fairer, more transparent, and stable market. However, these changes can come with unintended consequences, especially for active traders. Here's how regulations influence the broader market. Market liquidity. If trading fees rise or restrictions on market-making activities increase, liquidity can dry up, making it harder to enter and exit positions efficiently. Transaction costs. Regulations often lead to new taxes or compliance fees, raising the cost of frequent trading. Leverage and margin requirements. Many financial watchdogs adjust leverage limits to control risk, forcing traders to modify their position sizing and risk management strategies. Market access. Some regulations restrict access to particular financial products, such as banning retail traders from certain derivatives markets. Transparency and reporting requirements. New compliance rules can slow down execution times and reduce anonymity in trades, affecting how hedge funds and institutional players operate. Short selling restrictions. Some regulations limit or outright ban short selling during times of market stress, which directly affects bearish trading strategies. Now that we understand the overall impact, let's break it down by trading strategy. 1. Algorithmic and high-frequency trading, HFT. Let's start with one of the most heavily regulated areas, algorithmic and high-frequency trading. Over the past decade, regulators have cracked down on automated trading to prevent market manipulation and flash crashes. Here's how regulations affect algo traders. Order-to-trade ratios. Exchanges now limit the number of orders a trader can place relative to how many are actually executed. This discourages excessive cancellations by HFT firms. Latency arbitrage restrictions. Some markets have introduced speed bumps or minimum order resting times to reduce the advantage of ultra-fast trading systems. Anti-manipulation rules, spoofing and layering, where traders place fake orders to mislead the market, are now strictly prohibited. Circuit breakers. Regulators have implemented automatic trading halts during extreme volatility to prevent flash crashes caused by algorithmic trading. For HFT firms and quant traders, adapting to these rules means refining their models to focus on liquidity provision and arbitrage strategies that comply with updated regulations. 2. Day trading and scalping strategies. Retail day traders and scalpers are particularly affected by transaction fees, leverage limits, and short selling restrictions. Here's what's changing for day traders. Pattern day trading, PDT rules. In the US, traders with accounts under $25,000 are restricted from making more than 3-day trades within a rolling 5-day period. Increased trading costs. Some governments have introduced financial transaction taxes, FTT, making rapid trading strategies more expensive. Best execution requirements. Regulations like MiFID II in Europe require brokers to offer the best possible trade execution, affecting order routing strategies. Short selling restrictions. Regulators frequently ban short selling during market crashes, impacting traders who profit from falling prices. To stay ahead, scalpers and day traders must optimize their trade execution and consider trading assets with lower transaction costs to maintain profitability. 3. Swing trading and position trading. Swing traders and position traders hold trades for longer periods, so they are more affected by taxation policies, international trading rules, and economic regulations. Key regulatory changes affecting swing traders include taxation on capital gains. Some governments have introduced new tax brackets or raised rates on short term gains, incentivizing longer holding periods. Access to foreign markets. Cross border regulations may limit access to international stocks, forex pairs, or commodities. ETF regulations. Some regions have restricted leveraged ETFs, limiting options for swing traders who rely on them. Interest rate policy changes. Central banks' monetary policy changes impact the forex and bond markets, making macroeconomic regulations crucial for position traders. Swing traders must monitor tax policies and macroeconomic changes closely to optimize their strategies. 4. Fundamental and value investing strategies. For long-term investors, regulatory changes alter financial disclosures, accounting standards, and sector-specific risks. Here's how regulations impact fundamental traders. Corporate governance laws. Stricter disclosure requirements mean better transparency, but also increase compliance costs for companies. Sector-specific regulations. Industries like crypto, energy, and fintech often face sudden regulatory shifts that impact stock valuations. Banking and interest rate regulations. Rules governing central banks' interest rates and lending policies significantly affect equities and bonds. Environmental and social regulations. New ESG, environmental, social, and governance mandates affect industries like oil, mining, and manufacturing. Fundamental traders must stay informed on sector specific policies to understand how regulations impact stock valuations. Real world case studies of regulatory impact. 1. The Dodd-Frank Act and market liquidity. The Dodd-Frank Act, passed after the 2008 crisis, imposed capital requirements and trading restrictions on banks. While it reduced systemic risk, it also lowered market liquidity, making it harder for institutional traders to execute large trades. 2. MiFID II and trade transparency. Europe's MiFID II required brokers and hedge funds to disclose more trade data. While this improved transparency, it also made high-frequency trading less profitable due to lower market anonymity. 3. Cryptocurrency crackdowns. Governments worldwide have imposed crypto trading restrictions, taxes, and reporting requirements impacting liquidity and market volatility. Traders have had to adapt by shifting to regulated exchanges or decentralized platforms. How traders can adapt to regulatory changes. Stay updated, follow financial authorities like the SEC, FCA, and YesMA to monitor new regulations. Optimize risk management, adjust trade sizes and leverage in response to changing margin requirements. Explore alternative strategies. When regulations restrict certain trades, pivot to options, ETFs, or international markets. Leverage AI for compliance. Advanced trading platforms can help automate compliance tracking. Final thoughts. Regulations will continue to evolve, and the best traders are the ones who adapt. Whether you're day trading, investing long-term, or running an algo strategy, understanding regulatory changes is key to staying profitable. Platforms like Crystal Ball Markets provide helpful resources and valuable insights to help traders keep their strategies up to date. That's it for today's episode. If you found this discussion helpful, subscribe, leave a review, and share this podcast with fellow traders. Until next time, stay informed, trade smart, and stay ahead of the curve.